Welcome to my YouTube channel. My name is Phil Grande. I hope you had a great holiday. And now we're back in the saddle. We came back on Monday, and boy, we got a lot to talk about. So why don't we just get started, okay? Yesterday, you saw the market rally. I mean, the market sold off yesterday. You can see it right here. And it was a surprise to everybody except me. Matter of fact, I told everybody that when it started to rally up here like this, I drew a line right across here, and I said, this is where your support is. If this comes back and breaks it, we're going to have a sell-off. I said, and I thought that would happen, okay, because of the volume problems we were having, okay, because when the market was rallying and it was they're trying to rotate it, okay, to move higher, I knew they wouldn't get the volume. So, but here's another reason why the market dropped like this. Yesterday, what happened is there was an announcement that the Fed, they read the minutes, all the big guys, big boys at Wall Street read the minutes of the meeting, and they panicked. Now, why did they panic? Well, what happened is the answer for that is you got to go back to 2018. So if you go back to 2018 right here, okay, before that, from 2008 to 2018, the whole market has been driven by QE. What's that mean? Print money to buy treasuries, drop interest rates to zero. And in the early years of 2008, 9, 10, remember, we never went into a recession because they didn't want to break the banks, because they used the banks, okay, for leverage. What they did is the Federal Reserve, and first it was GW, he didn't want to break the banks up because his whole family's in banking, and Obama didn't want to break the banks up. But the real reason neither one wanted to break the banks up, because that's how they got in office, because it was the banks that funded them, just like the banks funded Hillary Clinton against Trump. So they decided not to do that, and they decided to instead go in and buy print all this money, buy all the bad debt from them, all the subprime loans, all the bad stuff, and put it on the Fed's balance sheet and have them, and they'll deposit into their checking account. Remember, they're paying 100 cents on a dollar for these mortgages that are worth 2 cents. And so now they got a lot of cash in their pocket. They have them go out and they buy stocks. They first bought their own stock. And they told them, go buy your own stock with the money we gave you. So because the market remember, the market is always led by banks. So after the crash, they had the money to go buy their own stock. That's where the stock buyback started. And within 4 months, the bank stocks rallied. Think about that. In 4 months, the bank stocks rallied. Right here, 4 months, the bank stocks rallied over 163%. After that, they told them, now we're going to give you more money, and we want you to go ahead and fund the hedge funds and brokerage houses, and we want them to go buy their own stock, and you're going to fund them with the money we give you. So make a long story short, from this point right here, okay, 2008 up to 2018, we have all kinds of, we have more money, okay, going in. In other words, the money supply is increasing like this, and productivity is increasing like that. And when that happens, prices accelerate like that. And that's what was happening from 2008 up to 2018. Now, Trump was elected. He was elected 2016, November. He gets inaugurated 2017. And he says, you know what? I'm going to do big tax cuts. And that we're going to drive the market up big time. We're going to drive up the tax cuts. We're going to drive economic growth. We're going to drive big earnings growth. And so that's 2018, he said that, right? Or 2017, with his big tax cuts. That's what he said he's going to do, right here. That's what he said he's going to do. Well, it didn't work, because what they thought was going to work, they decided at the same time to clean up all this mess back here, because you have all of this rally. It's all fake. Okay, it's all stock buybacks. So they just, and that has increased prices of everything like this. Okay, so they saw the inflation getting out of control. So they said, let's taper and we'll raise rates. Well, when they made that decision, right, and they thought they were covered because they thought they could do it because they thought the tax cuts would give them room. With the economic growth, it wouldn't affect the market. But the market dropped, okay, the market dropped 20%. Yeah. In 2018, the market dropped right here, 20% on them. All right there. So now they're panicked and they said, wait a minute, we got to get back to QE. This isn't working. So what did they do? They did 3 more cuts. Bam, bam, bam. And they started to move up the tech stocks. Remember, it's always the tech stocks. They always go back to Microsoft, Apple, Amazon, NVIDIA, Tesla, and Facebook, okay, to push the market up. Because remember, those stocks contribute 35 to 37% of every S&P rally. If you took those stocks out of the S&P, there'd be no rally, okay? So that's why it's so imperative for them to keep pushing those stocks up to push the S&P up. So they cut rates. That's what they did. And so, but at the same time when they cut rates, the yields were down about 55, 60 basis points. Wow. Tech stocks love that, and tech stocks soared. But at the same time, inflation's soaring, prices, everything's going up. But remember, they were at 55 basis points, 65 basis points. Loves it. Techs move up big time. But then all of a sudden, what happens? I'll show you. So all of a sudden, move this chart over for you. Here we are. The yields are 155 basis points. So we came from here, 2018, 2019. We drove all the way up to here. And now we went from 65 basis points to 155. And guess what happened? That's right. Tech stocks collapsed. That's what pushed the market down. But the timing was perfect, remember, because from 2008, remember, inflation's going up big time. Cost of gasoline, cost of everything's going up, right? Because of all this printing of money for QE. And when they got to this yield at 155, at the same time, the pandemic hit. The timing couldn't have been worse. Remember, the pandemic didn't cause this crash. The crash was caused by yields at 155 that drove the tech stocks down. And also was going to happen anyways because inflation was going crazy and prices are going too high. But when the pandemic hit and then it bottled up the docks, that's when everything hit and it dropped. But good news, the yields dropped down to 81%. They went in and they printed more money to get it yields from 155 down to 81, depending on they wanted to get back to the bank stocks, right? I mean, to the tech stocks. So that's what they did. So they drove all the way up to February now. There was the crash is over. Here's March. Remember, the rally, we lost 30% in 4 days. And we captured that back in about the same 4 days. It was the fastest fall and the fastest recovery ever. It was all because it was led by low yields that kept pushing up the big tech stocks to push up the S&P. So now we're in a situation that the yields are back to about 175. That's bad, right? Very bad. So here we are. So the yields are back now to 175. Let's see, show you the yields. All right, 172. See it right there? Yields are 172. And by the way, if you go all the way back, if you go back to 2018, okay, you'll see when that market crashed, 2018, the yields were 300 basis points in 2018, okay? So if you go all the way back to around 2018, right here, see it? All right, around 2018, okay, we were around 300 basis points. That's another reason why the market crashed in 2018, because the yields were so high, it just killed the tech stocks. It's the tech stocks that drive everything, right? So that's it. So now what happened is yesterday when they said they're going to do another tapering, and they're going to raise rates, the institutions panic because they say, wait a minute, this is 2018 all over again right here. They're saying this is 2018, okay, all over again. Why would you raise rates? Why would you raise rates? The last time you raised rates and tapered, we dropped 20%, for God's sakes. So, but they know, what Powell knows is they got to raise rates at some point because the inflation is getting out of the hand. Remember when they said it was transitory, how inflation was transitory when they lied about it? They know it wasn't transitory. Okay? So now they know that, look, they went to a recession back here. 2018, when the market crashed, they went into a recession. They dropped interest rates, right, down to 55 basis points so they could rally the market. And then they did the same thing here, right? Dropped interest rates again. And all that money they print to do that is causing terrible, terrible, terrible inflation. They blaming it on the pandemic, but it's also on all this printing of money. So here's the situation where we stand now tonight. If they move up the bank stocks, okay, let's say they decide to cut rates. They're going to cut rates, rather, and that way they'll move up the big tech stocks. Well, that's a problem for them because if they cut rates to move the big tech stocks up, they got to print all that money to buy treasuries to cut those rates. That means more inflation, more expensive gas, more expensive everything. Now, if they decide to stay with the banks and taper and raise rates, you saw what happened in 2018. The market panicked and sold off. And that's what's going to happen, okay? So Powell's stuck. Powell can't cut rates to raise the tech stocks up to bail them out. And he's stuck. He can't raise rates to push the big tech stocks, push the bank stocks up. So he can't raise rates to push the bank stocks up, and he's in a position he can't lower rates to push the big tech stocks up. That's what happens when you keep interest rates too low for too long. So the only thing that they can do, and this is why Biden is panicked, they figure if they could do another cut, and push the stock market up using the big tech stocks, right? Only if, because they know only inflation and everything's going to go up, as long as they subsidize everything. So that's why he's trying to get through his plan. Because in that plan, they got subsidies for rent, subsidies for everything, subsidies for payments, subsidies for your interest on your payments, and subsidies for lawn mowing. It's a socialist program. So they think, look, we can push the rates yields down and push the market back up with tech stocks. And even though gasoline's going up and everything's going up, it won't hurt the people because we're going to send them $1,400 a month. We're going to send their kids $3,000. We're going to send, all this crap that's going on. And that's why he's fighting to get that plan through. Now, if he can't get that plan through, there's only one place for this market to go, is down. Okay? Unless they want to try to push it back up and make people suffer more. But how much more can they suffer? They're missing their payments now, their car payments, their mortgage payments. So that's where we are. So we're in a great shape. So if you, again, please, join my gang for 10 days free and listen and learn how to sell short. Once you learn how to sell short, you got it made. Because then you don't care if the market's up or the market's down. You don't care if they're doing QE, if they're not doing QE. If you're sitting there and you always got to be right all the time, meaning you always got to buy stocks that are going up, that's pretty tough to do. When you short, you're not in that predicament. You're making money either side of the transaction. We'll show you how to do it. And if you don't want to sit for classes and learn and all that, that's okay. Every day, why don't you just pick a stock from our portfolio, and every day Steve goes to the portfolio and he tells every member what to do with each stock, whether shorting it or going long. You don't have to come to class if you don't want to, okay? But those who want to learn, we got the greatest classes in the world. So that's where we stand tonight, okay? The conundrum is he can't move rates up and he can't move rates down. The only thing that would bail him out if he could get that program passed with all the subsidies, then they could drop rates and push big tech stock, push the market back up, and all that inflation that goes up, gasoline and everything else, he can take care of that through subsidies. But I don't think that's going to happen. So my guess is we're getting very close to this crash now, okay? So If you like this, please hit subscribe, like, and share. I really hope you do. Listen to my radio show every day online, okay? It's on at 3 Eastern every day. It's archived. And I'll see you on the charts, okay? It's going to be an interesting week.